Do you believe that silver has finally broken the shackles? And what are your expectations for silver from here moving forward?
Yeah, I think one point that virtually everybody has missed is it's not just silver. I've got in front of me year-to-date performance, and top of the list is platinum with 56%, palladium 42%, copper 35%, and then we got silver 28%. And gold 22%. It's clear that this is more broadly based than just silver. And in fact, for my Substack readers, I put out an article yesterday examining the position repricing base metals, in other words, industrial metals, in gold. And the value of a basket of base metals is now 23% of what it was in 1900. Now, looking at the price in 1900 of that basket, that is actually really a sort of normal gold to base metal relationship. So to have it 77% below that today shows just how cheap base metals are. Now, silver has been trading as a base metal. It stopped being money in the official sense, as it were, in the 1870s. And of course, it has varied in terms of the gold to silver ratio, peaking, I think, just before COVID lockdowns in March 2020, with a gold silver ratio of about 121. Now it's back down to 87. Now, what is happening is that with gold running ahead, that has pushed down the ratio of gold to these base metals down to that 23%. But silver is beginning to escape with it. And not only that, but some other metals are beginning to move with it as well. So what we are seeing is not just silver moving up, but we're seeing the whole of the metal complex going into a bull market, if you like, relative to gold. So we then ask ourselves the question, well, does this mean that gold is too expensive? Because that could be the other side of the coin. Well, if you look at what gold is basically the safe haven out of credit risk, the principal risk being fiat currencies. The only way in which gold can fall from the current level against those currencies is if remedial action is taken by those currencies to deal with their ills. And we see absolutely no sign of that whatsoever. If anything, the fall in the purchasing power of these fiat currencies measured by their relationship with gold is accelerating. Now, this is very alarming. And we know all the reasons for this. We've discussed this, the debt situation, the impossibility of controlling government finances, and so on and so forth. But it is clear that the dollar and other fiat currencies are going to continue to fall against gold, giving the appearance of gold rising. So we come back to base metals. If base metals, including silver, measured in gold, have to rally to 4 times their current level in order to normalize their relationship with gold. And gold itself, measured in paper currencies, is going to increase even further. You can begin to understand why it is that these base metals, and particularly silver, are really beginning to shift. And just if silver just normalizes its relationship with gold, we're going to see that far, far higher. And if gold rises, in other words, paper currencies continue to fall, then measured in paper currencies, the value of silver, it's far, far too cheap, and it's probably never, ever been cheaper in recent years. So that's the basis of my bullishness, if you like, for silver. I think we just look at silver in terms of on its own merits. It's got completely suppressed, and that is now changing. And I think this sort of the suppression, it's almost accidental. Obviously there is suppression and there is manipulation in commodity markets. But when you look at the whole of the base metal complex being suppressed in terms of fiat currencies, I think means that there has been an under recognition or adjustment in the markets for the loss of purchasing power of those currencies reflected in base metals. In other words, base metals have been relatively suppressed over a considerable period of time. That is changing. It's a big change in our world, and it's got enormous implications for inflation, let's put it this way, the future purchasing power of these fiat currencies, because, the cost of goods and all the rest of it. And it doesn't matter whether we have an economic slump on the 30 scale, but the cost of everything, the base cost of everything, is rising because of the loss of purchasing power of the currency. Call it inflation if you like. So you can see this is an underlying problem which is going to emerge, I think, over the next 18 months or so.
If you've been following the precious metals market lately, you'll have noticed something remarkable, something that doesn't happen every day, every year, or even every decade. It's not just that gold is pushing higher. It's not just that silver is showing signs of life after years of being treated like the market's unwanted stepchild. No, this is bigger. This is the whole metal complex, from platinum to copper, starting to reprice itself in a way that tells us a fundamental shift is underway. Let me put some numbers in front of you. Platinum up 56% year to date, palladium 42%, copper 35%, silver 28%, gold 22%. That's not a narrow safe haven move. That's an across-the-board revaluation of the tangible, the industrial, and the monetary all at once. And that matters because markets don't do this unless something is deeply wrong in the paper economy. Now, silver's story is unique. For over a century since the 1870s, it's been stripped of its formal monetary role in most of the developed world. It's been lumped in with base metals, priced by its industrial demand rather than its monetary heritage. And while gold got to keep its safe haven crown, silver was left in the economic basement, fighting with copper and zinc for market attention. But here's the thing. Silver never stopped being money in the truest sense. It just stopped being treated as such. So why now? Why are we suddenly seeing silver begin to move not just with base metals, but also alongside gold? To answer that, we need to take a step back and look at the bigger picture. The relationship between gold, silver, and the rest of the commodity space. Historically, the value of a basket of base metals relative to gold has been far higher than it is today. In fact, when you measure it now, that basket is only 23% of its value in 1900. That's a 77% undervaluation relative to gold, and it's persisted for decades. Think about that. For the better part of a century, base metals have been priced as if the purchasing power of currencies hasn't collapsed. They've been treated as though the dollar of today is as solid as the dollar of 1900. And of course, that's nonsense. Every fiat currency in existence has been losing purchasing power, not gradually, but exponentially, particularly in the last 20 years. Yet the market never fully adjusted base metals for that reality. Silver, unfortunately for it, has been caught in that undertow. The COMEX futures market, the LBMA unallocated trade, the endless cycle of paper claims vastly outweighing physical availability, all of that piled on top of the underlying undervaluation caused by this broader base metal pricing distortion. The result? A metal that by every historical metric should be trading multiples higher, languishing in the high 20s. But now we're seeing the first signs of escape. And the timing isn't accidental. Gold is doing what it always does in the early to mid stages of a fiat crisis, repricing to reflect the degradation of the currency system. And when gold does that, it pulls other metals with it. First, the more monetary ones like silver, then the industrials as the inflationary implications kick in. Here's where we need to be brutally clear. Gold isn't rising because it suddenly became more valuable. It's rising because the yardstick we measure it with, dollars, euros, yen, is shrinking. If the value of your measuring tape changes every month, all your measurements change with it. And right now, those measurements are telling us something alarming. The purchasing power of major currencies is falling faster than most people realize. The problem is, markets have been slow to adjust in certain sectors, base metals being the prime example. That's why we now have this huge catch-up move starting to unfold. And when you combine that with the structural realities in silver, chronic supply deficits, booming industrial use from solar panels to EVs, and the return of investment demand, you get the perfect storm.
Why, in your opinion, has one of the world's largest investors taken this position of $318 million in gold?
There are two possible answers to that. I don't know Ray Dalio as an individual. I've never met him. But, either he sees a trend and he thinks, I've got to buy that trend. Or alternatively, he actually sees a lot of the dangers that we've been talking about and thinks that he should hedge that. So he's behaving, if you like a central bank, in the sense that central banks have been adjusting their reserves away from fiat currencies, and particularly the dollar, in favor of physical gold. I mean, he could rush out and buy physical gold for his hedge fund, but bear in mind that physical gold is not a regulated investment. His hedge fund, he will have people invested in his hedge fund who have compliance officers because they are part of the investment establishment. And you probably find that, he takes the view that, it's far easier for his investors to condone ownership of GLD than owning physical gold because of the regulatory position. I think you're right to point out that he apparently personally owns gold, but in physical form. And I think that's probably the more important point. It rather indicates that he does have a pretty good understanding of what the dangers are that lie ahead, and is acting rather like a central banker, not in the Western system, thinking, these dollars and all the rest of it, I don't know, that nice Mr. Putin we saw back at the International Forum in 2022 told us that they robbed him of his currency, and by the way, if you've got any gold stored with them, I'd get it out. So, there's this sort of understanding, if you like, of the difference between fiat currency and gold. And I think that understanding is spreading from the top down. If you've got a $20 billion hedge fund manager, then he is by definition closer to the top than, let us say, the bulk of the investment management industry. So I would expect more and more people in the investment management industry to begin to understand the dangers inherent in fiat currencies. And this will particularly be the case, I think, when bond yields start rising, because that's going to change every investor's arithmetic. It really is. And as I pointed out already, you look at what's happening with base metals. They've already started rising. I mean, the best performing top 5 commodities through the whole space, if you like, including softs and all the rest, have been base metals. I mean, okay, I'm including platinum and palladium as base metal. I mean, but let's say non-monetary metals. I mean, this idea of precious metals, I think is a nonsense concept, actually. This is already beginning to happen. You might sort of say it's interesting, because since I put out that article, I had one comment saying, well, mining methods have improved and all the rest of it, So actually, the idea that, metals should maintain a value against gold over the long term isn't necessarily correct. But hold on a minute. We're not talking about supply demand. I mean, you can look at supply, you can look at demand, for different metals and all the rest. They change all the time. You can also look at the prospects of, if you like, of large new discoveries.
You see, when we talk about silver breaking the shackles, we're not just talking about some poetic phrase to please the silver bugs on Twitter. We're talking about the realignment of an entire commodity complex whose prices have been artificially suppressed. Not in the shadowy Hollywood villain sense alone, but in the quieter, more insidious way markets have simply failed to reprice in line with the collapse of purchasing power in fiat currencies. And that collapse is accelerating. Look around. Platinum up 56% year to date, palladium 42%, copper 35%, silver 28%, gold 22%. These aren't isolated moves. This is a coordinated escape attempt from a prison cell built by decades of financial engineering, cheap credit, and deliberate ignorance. For over a century, silver has been shackled to the base metal category in the minds of most traders, especially since the 1870s when it was formally demonetized in much of the West. And yet, here it is again, straining at those chains, being pulled higher not just by investor demand, but by a broader awakening in base metals as a group. Now we have to address the elephant in the room. Is gold overpriced? That's the knee-jerk contrarian's question when they see gold leading the charge. But let's be rational. Gold's so-called overpricing only exists if fiat currencies are fundamentally sound. And they are not. The dollar, the euro, the yen. They are all trapped in balance sheets that look more like explosive devices than safe harbors. The debt trajectories, the budget deficits, the demographic time bombs, these are not the makings of a currency renaissance. They are, in fact, the very reasons gold is doing exactly what it should, serving as a safe haven outside the credit system. That's the irony. Gold's rise isn't about it suddenly becoming more valuable. It's about paper money becoming less so, and doing so at an accelerating rate. If the purchasing power of your measuring stick is shrinking by the month, everything measured in it appears to rise. Gold's simply the cleanest mirror we have for that distortion. Now here's where it gets fascinating. If the base metal basket, priced in gold, has to rally fourfold just to normalize to its historical relationship, and if gold itself continues to rise in fiat terms, the leverage embedded in silver is almost absurd. This isn't some Reddit-driven to-the-moon meme. This is a sober look at relative valuation. Even if silver just reverts to its long-term gold ratio without any overshoot, say 50-to-1 with 4,000 gold, you're looking at 80 silver. That's conservative. And that's without accounting for the chronic structural deficits in physical supply, the rapidly rising industrial demand from solar, EVs, and electronics, and the speculative chase once mainstream investors finally rediscover silver. Here's another piece of the puzzle that I think too many miss. The suppression hasn't been solely a matter of bank shorts on COMEX. It's also been the indirect consequence of the entire base metal complex being undervalued in fiat terms. When your market doesn't adjust base metals for decades of currency debasement, you get an environment where silver, part monetary metal, part industrial workhorse, gets dragged down with copper, zinc, and lead, rather than riding with gold. That correlation is breaking down now, and I believe it's going to be one of the defining market shifts of the next 18 months. And the implications go far beyond the charts. Because when your base costs, the very building blocks of infrastructure, manufacturing, and technology, rise sharply, it sets off a chain reaction. Call it inflation. Call it loss of purchasing power. Call it whatever you like. The point is, the fiat illusion of stability starts to tear. Even if we get a severe economic slowdown, the base cost of producing anything physical will be higher because the currencies in which those costs are priced are worth less. Now, if you want a bit of levity, picture this: the LBMA warning about counterfeit bars and artificial supply. That's rich, isn't it? This from an institution that oversees billions in unallocated contracts, promises to deliver metal that isn't there, and they're worried about a few fake bars? That's like an arsonist lecturing on fire safety while their pockets are full of matches. And this is where perception comes in. Most people still think in terms of nominal prices. They hear, the average home in America costs $400,000, and think in dollars. But priced in gold, that home has been getting cheaper for years. Right now, you're looking at roughly 30 ounces of gold to buy the median house. Compare that to past decades, and you see the divergence. Fiat says unaffordable. Gold says more affordable than it's been in years. That's the function of sound money. It maintains purchasing power even as fiat burns. If you'd taken the down payment you were saving in dollars 5 years ago and instead held it in gold, you'd be shocked at how much closer you'd be to your real estate goal today. Not because housing collapsed, but because your savings didn't erode. That's the essence of wealth preservation. Gold doesn't make you rich, it keeps you from being quietly robbed. And silver. Well, if gold is the sentinel guarding your purchasing power, silver is the guard dog that suddenly realizes the back door is open. Its industrial role means it benefits from all the base metal repricing ahead. But its monetary role means it also rides gold's coattails higher. That's why its volatility, as maddening as it can be, is also its gift. When the market reprices silver's dual nature correctly, it moves faster and further than gold. We're entering a period where those moves won't just be short squeezes or speculative bursts. They'll be structural. And when structural shifts happen, you don't get the luxury of waiting for the perfect pullback. You position early, you endure the noise, and you remember that the real wealth transfer happens quietly, before the headlines start shouting about record highs. You might ask, But won't they just smack silver back down like they have before? My answer is this. They'll try, but the mechanics are breaking. Physical demand is eating into available inventories at a pace we've never seen. Lease rates spiking to 7 to 8%, settlement delays in London stretching to 8 weeks, no shares available to borrow in SLV. These aren't the hallmarks of a market under full control. There's stress fractures in the dam, and once enough water forces its way through, the dam doesn't come down slowly. So yes, I think silver has broken the shackles. Not in the sense that we'll see a one-way rocket ride. Nothing in markets moves like that without corrections, but in the sense that the forces holding it down structurally for decades are now being overwhelmed by forces pushing it higher. The ratio to gold will fall, the industrial demand will tighten supply, and the monetary premium will return. And when that happens, you'll wish you'd acted when everyone else was still arguing about whether 28 silver was too high.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.